Welcome back to my channel. Today, we are going to dive into an important topic that every trader needs to understand, which is spread and commission. Now, let's get started. Firstly, let's talk about the spread. The spread is one of the most fundamental concepts in forex trading. So, what is it exactly? In the simplest term, the spread is the difference between the bid price and the ask price. The bid price is the price at which you can sell a currency, while the ask price is the price at which you can buy a currency. Now, the spread is essentially the broker's fee for facilitating the trade. It's just the fee you pay your broker to put on your trade. That's just spread. So now, instead of charging you a direct fee for each of the trade, most brokers make enough money through the spread. Take for example, if Euro USD pair has a bid price of 1.1000 and an ask price of 1.1003, the spread will be 3 pips. This means that as soon as you enter a trade, you are drawn down by 3 pips and you need the market to move at least 3 pips in your favor just to break even. Once you press buy or sell, the broker automatically deducts the price for the spread for that particular trade. So that has spread. Now, what are the factors influencing spread? We have different types of factors influencing spread, but I've listed some factors that are influencing spread. Number one is market liquidity. Liquidity refers to how easily an asset, such as a currency pair, can be bought or sold in the market without affecting its price. We have two types of liquidity, which is high liquidity and low liquidity. Currency pairs with high liquidity like Euro USD generally have tighter spread because there are more buyers and sellers in the market. Why the low liquidity is when there is low participants buying or selling a particular currency at a particular time in the market. This usually causes the spread to be high. Now, the second factor to consider is the trading volume of that particular currency. That is how many people are buying the particular currency at that time. Pairs with higher trading volumes usually have lower spread. Major currency pairs like Euro USD, which is the most traded pair, followed by GBP USD and USD JPY, typically have tighter spread because they are traded more frequently. Now, the third factor is volatility. During periods of high volatility, spreads can widen as the market becomes more uncertain. Events like economic announcements, geopolitical events, or market open or close times can cause volatility. This volatility is caused whenever, maybe take for instance, there is a release of news. That is when there will be high volatility. Then when there will be low volatility is when the market is about to close. So that's it. It can influence the spread. So now the next one is market hours. We have four different sessions in forex trading. We have Sydney section, we have New York section, we have London section, we have Tokyo section. So these spreads can vary depending on the time. The New York section controls most of the market. So during that period, the spread tend to be tighter, it tend to be smaller than during the Tokyo section where there is lesser participants in the market. Check the link in the description box where I talked about the market sections so that you understand the sessions in the market and the times they are being traded. Now, the fifth factors that can influence spread is economic data release, that is news release. Spread can widen before, during and after major economic news releases, such as non-farm payroll that is being released every first Friday of the month, the interest rate decision or GDP report. Now, the sixth one is the currency pair you are trading. Different currency pairs have different spreads based on their liquidity and volatility. Major pairs generally have lower spreads, while exotic pairs have higher spread. Pairs like Euro USD, GBP USD, they have lower spread. Unlike USD, CHF, NZD, JPY, they have higher spread than GBP USD. The reason is because these pairs that I've listed before, Euro USD, GBP, they are most frequently traded, unlike the other ones. Now that we have covered spread, Let's move on to commission. Why some brokers make money purely through spread, others charge a commission on top of the spread. This is especially common with ECN brokers who offer tighter spread but charge small commission per trade. This commission, some brokers charge commission whenever you want to deposit or you want to withdraw fund in their platform. That is their commission. Understanding spread and commission is crucial because they directly impact your profitability. Here are a few tips to help you manage spread and commission. Number one, choose the right broker. Depending on your trading style, choose a broker that offers competitive spreads and commission. If you are a day trader or scalper, look for brokers with low spreads and commission structures. Number two, trade during major sections. Major sessions are New York sessions, London sessions. Spreads tend to be lower during major trading sessions. When the liquidity is high, avoid trading during off hours when spread can widen significantly. Number three is be mindful of news events. Spreads can widen during major news events due to increase in volatility. If you're trading around news releases, be prepared for potential higher cost. Always calculate the total cost, including both the spread and any commission. This will give you a clearer picture of what you need to cover to break even. And that's a wrap up on today's video. Understanding spreads and commissions is the key to becoming a successful forex trader. Always keep an eye on those costs, as they can have a big impact on your overall profitability. If you found this video helpful, make sure to give it a thumbs up, share it with your fellow traders, and subscribe to my channel for more tips and insights on forex trading. Drop any question or comment you have below. I would love to hear from you. Thanks for watching.